There's a pattern that has killed 4 major currencies in the last 100 years. It's not complicated. It's not mysterious. It's a 6-stage sequence that plays out the same way every single time. Stage 1. The government prints money to solve a crisis. Stage 2. Prices start rising, but everyone believes it's temporary. Stage 3. Citizens lose confidence and begin moving wealth out of the currency. Stage 4. Capital flight accelerates as the smart money exits. Stage 5. Hyperinflation destroys the currency completely. Stage 6. The currency dies. It's abandoned, replaced, or simply becomes worthless paper. In 1923, the German mark followed this pattern. 4 years from stable money to total worthlessness. In 1991, the Soviet Ruble followed it. 90 years of existence, gone in 900 days. In 2008, the Zimbabwe Dollar followed the same path. From functioning currency to a $100 trillion note that couldn't buy a loaf of bread. And in 2018, the Venezuelan Bolivar followed it, losing 99.9% of its value and still falling. 4 currencies, 4 complete deaths, all within a single century. And every one of them followed the exact same 6-stage pattern. No exceptions. No variations. The sequence is mathematical, predictable, and inevitable once it reaches the later stages. And right now, in 2025, the United States dollar is sitting at stage 4, capital flight. Foreign central banks are dumping dollars. China has reduced its treasury holdings by over $300 billion since 2021. Russia eliminated dollar reserves entirely. The BRICS nations are building payment systems designed specifically to avoid using the dollar. The exodus has begun. We're not at the beginning of this pattern. We're 2 stages away from currency death. This is the story of how currencies actually die, why governments always deny it's happening until it's too late, and why the math shows that the US dollar is following the same path that killed 4 before it. Before we look at those 4 dead currencies, you need to understand the pattern itself. Because this isn't theory, it's documented reality. It happens every single time a government tries to print its way out of a crisis. Stage 1 is the trigger and the response. There's always a crisis, a war, an economic collapse, a debt problem. Something that creates massive government spending needs while destroying tax revenue at the same time. The government faces a choice. Cut spending drastically and risk unrest. Default on debts and get locked out of borrowing. Raise taxes and crater the economy. Or print money. Every time they choose printing, because it's politically easy, invisible at first, and lets them keep spending without immediate consequences. So the money supply explodes. Governments print to pay soldiers, to fund programs, to service debt. And at first, it seems to work. The crisis appears managed. Bills get paid, the system keeps functioning. Stage 2 is inflation emergence. Prices start to rise. Not catastrophically at first. 5%, 10%, 20% annually. The government blames external factors. War, supply chain disruptions, greedy speculators, foreign enemies. They never admit that printing money causes inflation. They introduce price controls. They threaten merchants with jail for raising prices. They flood the airwaves with propaganda, assuring citizens that inflation is temporary and under control. And many believe it, because they want to believe it. Because admitting the truth means facing the reality that their savings are being destroyed. Stage 3 is loss of confidence. This is the psychological breaking point. People realize the inflation isn't temporary. They see prices doubling year after year. They notice the printing never stops. They understand that holding cash means losing wealth. So they start making defensive moves. They buy real assets, gold, land, property, foreign currency. Anything that holds value better than the rapidly depreciating paper money. They spend cash quickly instead of saving it. They demand wages in something else, anything else. The velocity of money increases as everyone tries to get rid of it faster. That speed makes inflation accelerate even more. Stage 4 is capital flight. The wealthy and the connected see what's coming. They move their money out of the country. They convert to foreign currencies. They buy assets abroad. The middle class tries to follow but finds it harder. Banks limit withdrawals. Governments impose capital controls. But the money keeps flowing out, legally or illegally, because everyone with resources is trying to escape the sinking ship. Foreign investors pull out. International companies stop accepting the currency. Foreign central banks that once held reserves start selling. Global demand for the currency collapses. This is the critical stage, the point of no return. Once capital flight accelerates, Stage 5 becomes almost inevitable. Stage 5 is hyperinflation. This is when the currency dies in real time. Prices double weekly, then daily, then hourly. A loaf of bread that costs 10 currency units in the morning costs 20 by afternoon. Workers demand to be paid daily, even hourly, because by week's end, their wages are worthless. People carry cash in wheelbarrows because the amount needed for basic purchases is so huge. The government prints larger and larger denominations, million notes, billion notes, trillion notes. It doesn't matter. The more they print, the faster the death. Savings are wiped out completely. Pensions evaporate. Anyone who held wealth in the currency loses everything. Stage 6 is death. The currency is abandoned, officially or unofficially. The government might introduce a new currency, lopping off zeros from the old one. Or people might simply stop using it altogether, switching to barter, foreign money, or anything that holds value. The currency that once powered an entire economy becomes worthless paper in months, sometimes weeks. And everyone who trusted it learns the same brutal lesson. Paper money is only worth what people believe it's worth. And when that belief dies, the currency dies with it. Now let's look at what happens when that 6-stage pattern plays out in real history. 4 nations. 4 dead currencies. 4 warnings ignored. The German mark. The Soviet Ruble. The Zimbabwe Dollar. The Venezuelan Bolivar. Each followed the same steps. Each ended in collapse. And each tells us exactly where we are today. Germany's story is the blueprint. It shows how even the most advanced, industrialized, educated nation can destroy its own currency and its own middle class in less than 5 years. Before World War I, Germany's mark was one of the strongest currencies in the world. It was backed by gold, stable, trusted. The German economy was modern and powerful. Then came the war. Stage 1 began in 1914. Germany faced massive spending demands. Armies, weapons, supplies. They borrowed heavily, selling war bonds to citizens. But when Germany lost in 1918, the debts remained. Then came the Versailles Treaty. The Allies demanded reparations, 132 billion gold marks, an impossible sum. Germany couldn't pay through taxes. The economy was broken, so they printed. The presses began running day and night. The money supply exploded. From 1919 to 1923, printing became the default policy. To pay reparations, to fund recovery, to keep the system afloat. Stage 2 appeared by 1920. Inflation began rising. At first 5%, then 10%, then 20%. The government blamed the Allies, blamed speculators, blamed everyone but themselves. In 1921, inflation hit 50%. Still manageable, but alarming. People noticed their savings buying less. But the government assured everyone it was temporary. Then came Stage 3, the breaking point. By 1922, inflation hit 200% annually. Confidence collapsed. Citizens began dumping marks as fast as possible. They bought furniture, food, gold, anything real. Workers demanded daily wages because by payday their money had already lost value. The speed of transactions exploded, everyone racing to get rid of marks before they died in their hands. By mid-1922, Stage 4 had begun. Capital flight. The wealthy moved money abroad, to Switzerland, to America, anywhere but Germany. Foreign investors withdrew. International companies refused payment in marks. The government tried to stop the bleeding with capital controls, but money found its way out anyway. Every mark leaving Germany weakened the ones left behind. And then came Stage 5, hyperinflation, 1923, the year money died. In January 1923, $1 bought 18,000 marks. By August, it bought 4.6 million. By November, it bought 4.2 trillion. The numbers stopped making sense. A loaf of bread that once cost 1 mark before the war now cost 200 billion marks. The government printed 500 billion mark notes, then trillion mark notes. None of it mattered. The more they printed, the less the money was worth. People carried wages home in baskets and wheelbarrows. Women lit stoves with banknotes because paper burned better than wood. Restaurants changed prices between courses because by the time the main dish arrived, the money had already lost value. It was chaos. And yet, the government kept printing, insisting stability was just around the corner. By November 1923, the German mark was dead. Stage 6, currency death, was complete. The government introduced a new currency, the Rentenmark, to replace the old one. One Rentenmark for 1 trillion old marks. Every citizen who held savings, pensions, or wages in marks was wiped out overnight. The middle class, the backbone of German society, was destroyed. Years of savings became worthless paper. Only those who had converted their wealth into gold, property, or foreign currency survived the collapse. 4 years. That's all it took. From one of the strongest currencies in the world to complete worthlessness. The pattern played out perfectly. And the consequences didn't end with the economy. The collapse of the mark shattered faith in institutions, destabilized politics, and opened the door to extremism. Economic chaos paved the way for dictatorship. Currency death became national death. The next story follows the same pattern. Different system, same result. The Soviet Ruble. The ruble's death came decades later, but the sequence was identical. The Soviet ruble had existed in its modern form since 1961. It was a controlled currency, not freely exchangeable, but it functioned within the Soviet system. For 30 years, it worked. Then the cracks began to show. Stage 1 began in the 1980s. The Soviet economy was stagnating. Oil revenue, which had sustained the system through the 1970s, began to collapse as prices fell. The war in Afghanistan drained billions. The arms race with the United States consumed everything else. By 1985, the Soviet government was spending far more than it earned. The choice was the same as always. Cut spending and risk unrest, default, or print. They printed. The money supply ballooned. Rubles flooded the system. More money chasing the same limited goods. Stage 2 appeared by the late 1980s. Inflation crept into daily life. Officially, the government claimed prices were stable because it controlled them on paper. But in reality, people couldn't find goods at official prices. Store shelves were empty. Black markets exploded. People paid 10 times the listed price just to buy what they needed. The government denied inflation existed. They pointed to official statistics. They said shortages were caused by distribution problems. But the truth was obvious to anyone standing in line for bread. Stage 3 hit by 1990. Confidence collapsed. Soviet citizens understood the ruble was dying. Everyone who could hoarded US dollars or German marks. Foreign currency became real money. The black market exchange rate diverged wildly from the official rate. Officially, $1 equaled 6 rubles. On the street, $1 bought 30. People traded secretly in dollars, gold, and cigarettes. Anything but rubles. The velocity of money rose sharply. As soon as people got paid, they spent their rubles. Nobody wanted to hold cash that lost value daily. Even inside the Soviet Union, rubles were rejected for real trade. By 1990 and 1991, Stage 4 arrived. Capital flight. The elite and the well-connected moved their wealth out of the country. Money flowed west, into foreign accounts and offshore havens. The Soviet Union was disintegrating politically and economically. The currency was collapsing. Oil, the country's main export, was being sold for dollars that disappeared into private accounts abroad. The ruble hemorrhaged value both inside and outside the borders. Foreign reserves evaporated. The government tried to control the outflow, but the system was too broken to stop it. Then Stage 5 hit, hyperinflation. The ruble entered free fall. When the Soviet Union dissolved on December 26, 1991, the currency collapsed with it. In 1992, inflation in Russia hit 2,500%. Prices multiplied by 26 in a single year. In 1993, another 900%. Savings vanished. Pensions became worthless. Entire generations lost everything overnight. The government printed higher and higher denominations, but it was meaningless. A 1,000 ruble note bought what a single ruble once did. People's salaries couldn't keep up with the pace of collapse. Shops changed prices daily, sometimes hourly. Stage 6 followed, just as it always does. The Soviet ruble was replaced. In 1993, the Russian government issued a new ruble at a 1-to-1 rate, requiring citizens to exchange old notes within a deadline. Those who missed it lost everything. Then in 1998, Another redenomination. One new ruble for 1,000 old ones. A currency that had functioned for 90 years was effectively gone. The Soviet Union collapsed, and the ruble died with it. Different country. Different ideology. Same mathematical sequence. First, crisis and printing, then inflation, then loss of confidence, then capital flight, then hyperinflation, then death. The names change, the systems change, the excuses change. But the pattern never does. The Soviet example is crucial because it proves something most people don't want to believe. Even a superpower with immense resources and global influence cannot print its way out of decline. The ruble's death was not a shock. It was the inevitable outcome of years of denial and political self-deception. By the time the collapse began, it couldn't be stopped. The same people who said it couldn't happen here were left holding worthless paper. That's always how it ends. The collapse of the Soviet ruble destroyed confidence not just in the currency, but in the entire system that supported it. And when faith in money dies, faith in government follows. That's why currency collapse isn't just an economic event. It's a psychological and political one. And the next example, Zimbabwe, shows how quickly it can happen when politics and printing collide. A nation that went from independence to total collapse in less than 3 decades. A currency that reached $100 trillion and still couldn't buy lunch. Zimbabwe gained independence in 1980. For the first 20 years, its economy was strong. Agriculture thrived. The Zimbabwe dollar was stable, trusted, and respected across Africa. Then came the first stage, crisis and printing. In 1999 and 2000, the government began seizing white-owned farms and redistributing them. Agricultural production collapsed almost overnight. Zimbabwe went from a food exporter to a nation that had to import food just to survive. Tax revenue plummeted. But instead of cutting spending, the government printed money to fill the gap. Stage 1 was complete. Stage 2 followed fast. By 2001, inflation began to rise. 10%, 20%, then hundreds. By 2003, prices were up over 100% per year. By 2004, 600%. The government blamed everything except printing. They blamed sanctions, they blamed drought, they blamed the West. They introduced price controls, jailed store owners for raising prices, and printed even more to pay government salaries. It didn't matter. The math was unrelenting. More money chasing fewer goods always ends the same way. Stage 3 arrived between 2005 and 2007. Confidence broke. Ordinary citizens stopped believing in the Zimbabwe dollar. People spent money the same day they got it because by tomorrow it would buy less. Workers demanded daily pay. Salaries were worthless within a week. Those who could converted their money into anything else. US dollars, South African rand, gold, livestock, food, anything real. Shops quietly began accepting foreign currency, even though it was illegal. Because nobody trusted the local one anymore. By 2007, the country entered stage 4, capital flight. The wealthy and politically connected moved their money out of Zimbabwe, to South Africa, to offshore accounts, anywhere else. The government imposed capital controls, froze withdrawals, and banned foreign currency. But the exodus couldn't be stopped. Once people lose faith, no amount of force can bring it back. Foreign investors left. Foreign banks closed branches. Imports vanished. The value of the Zimbabwe dollar collapsed internationally. No one wanted it. No one trusted it. Then came stage 5, hyperinflation. 2008, the year of the $100 trillion note. Inflation hit 11 million%. Then 230 million. By November, 79 billion% in 1 month. Prices doubled every day, sometimes every hour. People carried stacks of notes taller than themselves just to buy groceries. Shops changed prices mid-morning. Cashiers needed calculators with extra digits. The government printed higher denominations constantly. 1 million, 1 billion, 1 trillion. Eventually, they printed a $100 trillion note. It couldn't buy bread. Savings disappeared. Wages meant nothing. People traded food for fuel, shoes for soap. The economy regressed to barter. Then came stage 6, death. In 2009, the government officially abandoned its own currency. They legalized foreign money, US dollars, South African rand, British pounds. The Zimbabwe dollar was gone. In 2015, they made it official. If you had 35 quadrillion Zimbabwe dollars, you could exchange it for $1. $100 trillion of local currency, worth 40 cents. It took just 29 years for Zimbabwe to go from independence and stability to total monetary extinction. And every stage followed the exact same script. Then came Venezuela, the most recent and still unfolding example of currency death in real time. Venezuela in the early 2000s was rich. It had the largest proven oil reserves in the world. Oil paid for everything: housing, healthcare, social programs. The Bolivar was strong. People believed it would always be that way. Then came stage 1, printing in crisis. Oil prices fell. Government spending didn't. The Chavez administration began printing bolivars to cover deficits. By 2013, the money supply was exploding 50% per year. Stage 2 arrived by 2014. Inflation emerged. Prices rose 60% annually, then 100, then 180. The government blamed economic war. They blamed the United States. They blamed business owners and speculators. They arrested store managers. They imposed price controls. They nationalized companies. And they kept printing. Stage 3 hit by 2016. Confidence collapsed. Venezuelans started dumping bolivars for US dollars on the black market. The official exchange rate said 10 bolivars per dollar. On the street, it was 4,000. Nobody believed the official numbers anymore. People spent bolivars as fast as possible. Supermarkets demanded payment in dollars. Savers converted everything they could into food, gold, or crypto. The velocity of money exploded. Stage 4, capital flight, began in 2017. The wealthy had already moved their money out years before. The middle class tried to follow. The government banned dollar accounts, froze transfers, and imposed withdrawal limits. But the outflow continued. Capital doesn't obey politics. It obeys survival. Foreign companies stopped accepting bolivars. Even Venezuela's own oil company demanded payment in dollars or Chinese yuan. No one trusted the local currency anymore. Then came stage 5. Hyperinflation. 2018. 1 million% inflation. Then 10 million. Then numbers too large to calculate. The government responded by printing new money again and again, each time deleting zeros. In 2008, they removed 3 zeros. In 2018, they removed 5. In 2021, they removed 6 more. A total of 14 zeros gone. And still, the bolivar kept dying. By 2020, shops didn't even price goods in bolivars. They priced in dollars. 90% of all transactions now use US currency. The bolivar technically exists, but it's a ghost. It's still printed, but no one uses it. It's a dead currency walking. And that brings us to today, to the dollar. The same pattern is already visible. The same sequence. The same psychology. The same denial. Stage 1 for the dollar began in 2008. The financial crisis hit, and the Federal Reserve printed trillions under a new name: quantitative easing. It was printing by another word. The crisis passed, but the printing never stopped. Then came 2020. The pandemic shutdown. The government printed $6 trillion in 2 years. The US money supply rose 40% between 2020 and 2022. The fastest expansion in history. Stage 2 followed immediately. Inflation appeared. First, the Federal Reserve called it transitory, temporary, a supply chain issue. Then prices rose 7%, then 9%. The excuses multiplied. They blamed Russia. They blamed war. They blamed supply chains again, never the printing. Stage 3 is now unfolding. Confidence is weakening. Not collapsing yet, but cracking. Americans are buying gold at record levels. Crypto adoption is soaring. People are holding less cash and more hard assets. The psychology is shifting. They're not trusting the dollar the way they used to. And now, the world has entered stage 4. Capital flight. Foreign central banks are reducing dollar exposure. China has cut treasury holdings by over $300 billion since 2021. Russia holds 0. BRICS nations are building alternative systems. M-Bridge, cross-border settlements in local currencies. Saudi Arabia is accepting yuan for oil. India trades with Russia in rupees. The world is moving away. Global dollar reserves have fallen from 73% in 2000 to under 55% today. That's capital flight, slow, steady, and growing. The smart money is leaving first, just as it always does. And once the exits fill, the crowd follows. Stage 5 hasn't arrived yet. We're not in hyperinflation, not yet. But mathematically, the path is forming. $36 trillion in debt, $2 trillion annual deficits, over $1 trillion a year in interest payments, a government that prints whenever crisis hits. The pattern doesn't care about politics. It doesn't care about optimism. It doesn't care about slogans. It's math. And math always completes its sequence. 4 currencies before thought they were different. The German mark, the Soviet Ruble, the Zimbabwe Dollar, the Venezuelan Bolivar. Each believed it could bend the rules of economic gravity. Each ended in collapse. The US dollar stands at stage 4. Capital flight is accelerating. Confidence is weakening. The world is preparing alternatives. History suggests what comes next. Stage 5. Then stage 6. Unless the pattern is broken, the outcome is the same. Because money, in the end, isn't backed by government. It's backed by belief. And when that belief fades, even the strongest currency can die. If history has proven anything, it's that no currency, no matter how powerful, is immune to collapse. Every empire has said the same thing. It can't happen here. Rome said it. Spain said it. Britain said it. And now, America says it. But history doesn't care about pride. It only cares about patterns. And the pattern is already in motion. Stage 5 is hyperinflation, the point where money dies in public. It starts quietly. Inflation that the government can't seem to bring back down. Budgets that don't balance no matter how high taxes go. Debt that grows faster than it can ever be repaid. Then comes the breaking point. When confidence finally snaps. When foreign buyers stop showing up at treasury auctions. When the government has to print money not just to fund programs, but to pay interest on its own debt. That's when the spiral begins. Prices start to rise faster than wages. People notice. They rush to spend their money before it loses more value. That rush increases the velocity of money. And that velocity feeds back into higher prices. It becomes a loop. A self-reinforcing cycle that no policy can stop. The government raises rates, but can't afford the interest. It cuts spending, but triggers chaos. So it prints again. Each solution makes the problem worse. At first, inflation hits consumer goods, then rents, then energy, then food, then everything. Savings vanish, pensions collapse, investments priced in nominal dollars lose real value, cash becomes poison. And yet, during every hyperinflation, governments promise the same thing. We have it under control. They lie to buy time. They lie because telling the truth would cause panic. But panic always comes anyway. As inflation accelerates, the population adapts in desperate ways. Businesses raise prices daily. Workers demand to be paid in something else, gold, goods, or foreign money. People stockpile food instead of cash. The rich move assets abroad. The poor trade on the streets. The entire economy fractures. When the US reaches that point, if it does, it won't look like Germany in 1923. It'll be digital. The panic will move at the speed of the internet. Money will die in screens, not in paper. Digital bank runs, instant asset conversions, online barter systems and crypto alternatives emerging overnight. Hyperinflation in the digital age will be faster, sharper, and more chaotic than anything the world has ever seen. Stage 6 follows, the official or unofficial death of the currency. It can happen through formal replacement or silent rejection. The government might introduce a new digital dollar, a central bank currency designed to restore control. They'll claim it's modernization, a way to stabilize the system. But it will really be a reset. Old dollars converted into new at a punishing exchange rate. Zeros erased. Wealth quietly confiscated through conversion. Or the death may happen from below, from the people themselves. Merchants refusing the dollar. Workers demanding payment in other forms. Foreign trade moving to alternate systems. The dollar still exists on paper, but functionally it's finished. And when the world stops using it as a reserve, everything changes. For 80 years, the dollar has been the backbone of global trade. Oil, commodities, loans, all priced in dollars. That demand created artificial strength. It let the United States borrow endlessly and spend without consequence. But reserve status is not a right. It's a belief, and that belief is fading. As countries trade in yuan, rupees, or gold, global demand for dollars falls. Less demand means lower value. Lower value means higher prices at home. Higher prices mean more printing to cover costs. The feedback loop tightens again. When a reserve currency dies, it doesn't happen all at once. It's a slow erosion that ends suddenly. Confidence builds over decades and collapses in days. At first, the world diversifies, then it hedges, then it abandons, and by the time the collapse is visible, it's already complete. History offers no exceptions. Once capital flight reaches critical mass, reversal is almost impossible. No law, no promise, no speech can restore faith once it's broken. That's why every government insists, right until the end, that their money is safe. Because admitting the truth would accelerate the fall. When the final stages arrive, the signs will be unmistakable. Treasury yields will spike uncontrollably. Foreign reserves will be liquidated. Exchange rates will swing violently. Supermarket shelves will change prices multiple times a week. Ordinary citizens will convert cash to goods instantly. And the government will respond with denial, controls, and panic. They will freeze accounts for stability. They will cap withdrawals to prevent speculation. They will create emergency programs to protect the public. But the more control they apply, the faster trust disappears. The collapse of a currency is not just an economic event. It's a psychological contagion. Once people stop believing, recovery becomes impossible. The dollar is not dead yet. It still dominates global trade. It still holds inertia and legacy trust. But inertia isn't immunity. It's delay. 36 trillion in debt. Trillions more printed every time crisis hits. Deficits that can never be closed. A population losing faith in its own system. The ingredients are all there. Could the US escape? Possibly. But it would require something no empire has ever done. Deliberate self-restraint at the peak of power. It would mean stopping the printing, cutting the spending, enduring the pain before the collapse. And history shows that no government has ever chosen pain voluntarily. So the pattern continues. Stage 4 becomes Stage 5. Stage 5 becomes Stage 6. And when it's over, the world moves on to a new system. The question isn't whether a new reserve currency will emerge. It's what form it will take. Maybe it's a basket of national currencies. Maybe it's gold-backed trade units. Maybe it's a digital system built by the nations now leading the exodus. China, Russia, India, the Middle East. Or maybe it's something entirely new. But it won't be the dollar. Because once confidence breaks, it never returns. 4 currencies have already shown the map. The German mark, the Soviet Ruble, the Zimbabwe Dollar, the Venezuelan Bolivar. Each followed the same 6 stages. Each believed it could bend the rules. Each ended the same way. And now the dollar stands where they once stood, 2 stages away from the end. The governments of the past all promised they could manage it, that they could control it, that their situations were different. They were wrong. So the question isn't if the pattern completes. It's when, because the law that governs money isn't written by politicians. It's written by math, psychology, and trust. And those 3 always win. When belief in paper dies, so does the empire built on it. And when that day comes, the final chapter of the dollar will be written, not by economists, but by history itself. And history, as always, will simply say, they thought they were different.